So I wanted to shoot this very quick video for you guys of me rolling a strangle on the IBKR Trader Workstation desktop application. Now, the reason why I'm using the Trader Workstation application is because when you want to roll a multiple leg strategy as a complete trade, you have to do it using Trader Workstation. Unfortunately, the IBKR mobile tablet application is very limited in its features when it comes to a multi-leg strategy, especially when you want to roll them. I've not found anywhere on how you can actually do it, but if you know how to do it, please comment down below. I would love to not use this application because, as you can see, it's not the most intuitive platform. The UI isn't that great. It does look a bit complicated. So what I want to do is just walk you guys through on what I'm doing, how much premium I'm going to get, and why I'm doing it. So I'll be rolling a strangle for Coinbase. Now, today is the 21st of February. We're currently during market hours, and Coinbase is expected to release earnings today. So what I wanted to do was just roll this strangle out, widen my strike slightly, just in case we get some massive crazy move, which I'm expecting. I'm not really fussed if it's to the upside or the downside. I just want to be prepared for it and give myself some time to be right in case we do get that massive move. So I'm in the rolling screen here, and at the top what we have is our buyback of the current strangle, and at the bottom we have the next monthly expiration, in this case April the 21st, which then gives us the ability to set new strikes or keep the strikes the same. And then over here gives us a window of what is going on and what the aggregate premium you expect to receive or pay depending on what you're trying to do. Now, when you're in this position, you can manipulate the view in terms of how you want to look at your expirations, which expirations to show, how many strikes to show, etc. So I'm ranging them in $5 strikes from 40 all the way up to 85 for what I'm buying back and to what I'm selling. So when you get to the screen, it pre-defaults in you buying the strikes that you had. So I have a $50 put and a $75 call, which you can see here that I'll be buying back, which it doesn't tell you. So that's about what, $800-ish to buy this back, which is pretty good in terms of what it is. And now what I want to do is widen out my strikes. So if we actually go to the 75.50, if I wanted to keep the strikes exactly the same, you can see here that I'll be making around $500 in terms of premium, in terms of the mid price of $530. So $530 to place this trade. This is not a bad trade, but we know how volatile Coinbase can actually be. So I want to give myself some additional protection here in terms of widening out my strikes. So if we were to go to the $80 strike, and if I go back to the $40 strike, we can see here the mid price is around 104, which is not as much premium as $500, but that allows me to de-risk where I need to be here with a delta now of nearly 0.86. So I'm trying to get as much delta neutral as I possibly can while still maintaining a net credit. So if we think about what we're doing here, we're buying back this strangle, and I have been adjusting my position. I have made around $600 off the March 17th strangle, so I have to add that premium on when I eventually get out of this trade. But I'm looking as Coinbase, because it's a volatile stock, to keep it as a core position and keep rolling this at least for the next year or so and picking up net credits along the way. So I like to start with the wide strike. If things start moving in one direction, I can adjust my strikes to still continue to pick up premiums. That's what I did in the March option. I'll be doing the same in the April option. Best case scenario for me as it currently stands is for Coinbase to not move as much, therefore getting my out the money call and put to decay a lot quicker because it's not hitting any of my strikes. I want to try to keep this as delta neutral as possible, and I'll be adjusting my strikes accordingly. So if Coinbase does take an up move from 64 and it goes up to 70, 75, this put option here that's currently costing me around $254 will probably be worth around $120 as an example. It'll probably lose 50% of its value. So I'll be looking then to increase the put strike up to around the 45.50, generate more premium, neutralize my deltas. That's how I kind of manage these actual positions. So that's what I wanted to show you. So what I'm going to do now is again look at that mid strike of 104. I will now submit the order and let you know what exactly I get filled at. So you can see on your screen now that I have got this order filled. So we bought back the $75, $50. If I just scroll this down slightly, we bought back the $75 and $50 options, and then we sold to open the 80 and 40. And again, I got filled at $1.04. So times by 100 shares, $104 for placing this trade. So I've reduced my risk by extending out the duration and widening out the strikes. This is why I trade options, because you have a lot of things going on inside your favor, continually getting that income, passive income, cash flow coming in through the door, and de-risking at the same time. These are the most exciting trades that I love to do. So I really hope you've enjoyed this video. Check out the video on the screen now, which again shows you one of my best options trading strategies, and I shall see you guys on the other side.